Welcome back to All Things Money. I'm David Blain, and during today's show, I'm answering some common questions about the economy and what's going on, our feelings of what's going on with government debt, government spending. We'll get into real estate in this segment, as well as, if we have time, we may talk a little bit about health care. Remember, the show is about you and your money, so we welcome your comments and questions. Our phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And you can always visit us on the World Wide Web at www.dlblain.com. There you'll find information about myself and my company, as well as archived copies of the show. So let's get back into it. Before the break, we were talking about the federal government spending and how since 1968, Medicare and Medicaid was 4% of government spending. Social Security was 13%. In 2008, the most recent numbers I'm looking at, Medicare and Medicaid were 20%. Social Security was 21%. We look at net interest has only gone up from 6% to 8% from 68 to 2008. As I mentioned, that's simply a function of the low interest rates that we have today, that if interest rates spike up, that number is going to increase exponentially. What I wanted to talk about here is I get a lot of questions about the real estate market and when is housing going to recover? When are we going to see homes beginning to sell? And I want to talk a little bit today about what I call and other economists call the shadow inventory of homes, which, by the way, we estimate right now about 7 million shadow inventory. What do we mean by shadow inventory? Shadow inventory is defined to be all delinquent borrowers that are 30 or more days behind on their mortgage payment, as well as borrowers that are currently in foreclosure. That's what we call the shadow inventory. So that's all borrowers that are 30 or more days behind on their payments, as well as those borrowers in foreclosure. And why is this number important? Other than the fact that we don't want people getting foreclosed on and put out of their homes, from an economic perspective and looking at the housing recovery, it's already a very soft real estate market. Prices are firming up in some places, but we're not seeing the buyers return. As soon as you see any sort of little uptick in the home sales rate, part of the shadow inventory comes on the market, and you immediately see a flood of new homes. For example, we look at when a borrower gets behind on his mortgage or the foreclosure process begins, the banks and the mortgage companies are so overwhelmed with this process that essentially you have people living rent and mortgage payment free in homes for at least a year, in many cases 2 to 3 years. It can take up to 3 years from the time a person misses their first payment until they're actually out of their house. And we see this sort of subculture out there today of people actually intentionally not paying their mortgage, realizing that they're not going to be foreclosed on anytime soon. Mr. Romick of FPA Funds tells a story of his hairdresser or barber or whatever. He'd been living in his house basically rent-free, tax-free for about 2 years now. Was taking vacations in Hawaii and things like that. So this shadow inventory of homes is estimated to be about 7 million. And so what's going to happen is between now and the next several years, we would anticipate between 2 and 2.5 million of these homes coming on the market each year. And as these new homes come on the market each year, it adds to the already excessive inventory of homes that we have. So the bottom line is we don't see a sustained recovering housing anytime soon. There's just too many houses on the market, and then there's this whole shadow inventory of homes. Borrowers are continuing to fall behind on their payments, and so as the foreclosure rate either stays the same or even increases, you're going to have this continuing influx of homes on the market. We'll spend about a minute or two here. I get a lot of questions on the healthcare reform. It's interesting. The founding fathers of our country were, doctors and lawyers and scientists and philosophers and inventors. And today, we basically have professional politicians running the country. And so what happens is you end up with a health care bill like we have that really doesn't address any of the problems. We certainly embrace the concept of more health care for people and helping people out. The problem is that this health care bill does little to accomplish it. If we look at health care spending as a percent of GDP from 1960, we spent about 5.2% of our GDP on health care. In 2007, it was up to 16.2%, and this comes from the Medicare and Medicaid statistics group. So 16% of our GDP is already spent on health care spending. This is significantly higher than the majority of the developed countries around the world. The average is 12.9%. And the health care bill did nothing to address the cost of health care. And so we have in our economy, as the economy continues to recover, in fact, this bill, we're already seeing increases being levied by the health insurers in the marketplace. And so we don't think that this bill is going to do anything to help the economy and certainly not help cover additional people. Well, that brings us to the end of this segment. When we come back, we'll be taking a look at some of our viewers' questions. But just to recap, we're looking at the government debt is unsustainable going forward. For All Things Money, this is David Blain, and we'll be right back after the short break.